Hello, I'm Manueltos, and today I am here to host a discussion and an explanation of a master thesis on free banking versus central banking. I'll let my guest introduce himself.
Hello. I'm Perceval. Um, I've been on this channel before, and today I would like to bring to you probably one of the most, in my opinion, important topics that is not sufficiently being discussed in the economic literature.
Okay, so what makes free banking or central banking or perhaps monetary policy in general important?
So, of course, as everybody knows, the economy is ever present in society. It's the allocation of scarce resources, and as everyone knows, nearly everything is scarce. So, economy is definitely one of the most important things in society and human life, I would say. And the thing about banking is that it is, um, again, when it comes to money, it is the most used economic good. In fact, it is the economic good that is used in every single transaction nowadays, since a monetary sector is developed in virtually every society on the planet by now. And this monetary system that we're using right now, again, in virtually every at least developed monetary system on this planet, um, it's a central banking system that we're using now, and it just doesn't serve society in terms of stability and efficiency nearly as much as a free banking system would. And I think it's time that more people start to realize this, not just on a face value, like some standard, simple arguments like, oh, competition will fix stability, competition will fix efficiency. I really want to dive deep into the theory and show with well constructed arguments and from a very profound perspective that central banking indeed is inferior to free banking when it comes to economic stability, especially in the long term.
Yes, because a lot of people think of economics mainly in terms of commerce and investment, but they don't really look at the underlying structure of finances and money supply that help structure all of those transactions in commerce, as well as how investment proceeds. So these structures that emerge in the financial sector, whether through private forces or through governmental action, really have an enormous impact on how an economy functions.
Yes. And I would argue that even though, as I just said, money is probably used by virtually every adult citizen of developed countries on the planet, it seems like nearly none of them actually know what money is, what money should be, and yeah, especially from a theoretical standpoint, how it should be treated, right? The central banking perspective mostly interprets money as this magic wand that can be just brought about from a central institution. And just this central institution will make sure that they will treat or send or control the money in a way such that the economy will be stable and growing and efficient and all of those things. But that's simply not how money works. Money works just like every other goods in the economy. It has a supply, it has a demand, and it should be subject to supply and demand, just like I would argue nearly every other good in the economy. And I hope after my explanation of this at length, that more people are able to conceptualize that line of reasoning.
Yeah, certainly. I look forward to hearing your explanation then.
Yes. So I will begin at the beginning. Um, for those of you who don't know what free banking is as opposed to central banking, free banking is essentially the laissez-faire monetary or banking sector. In that case, there is no government or state sponsored central monetary authority that determines things like money supply or interest rates or minimum reserve requirements or those things. Yeah, as I said, the banking sector is a yeah, free market economic sector. There are no barriers to entry, there's no barriers to exit. Banks are just competing private firms that both compete in the money issuance market and the deposit taking market. Um, Again, there's no additional regulation on the banking sector. For example, there's no deposit insurance issued by the government. Um, So yeah, it's essentially just a free market of banking, and the model that I'm defending does include some universal monetary standards for which the issued bank money should be redeemable. And as you will see later, that's a fairly important um, aspect of the theory that I'm defending. So, without further ado, I'll talk a bit more about the outline of my work that I'm presenting here. First, of course, I will give a theoretical summary of the free banking theory that I'm defending, where I provide a description of how the money is in this system, the bankers, how they behave, and also customer behavior, among a few other things, which we will see later. After I've given a description over the many aspects of this theory, I will talk a bit more about the model that arises from this system, where we look at how rational behavior of the different actors, the bankers and the customers, will eventually turn into certain equilibria that will be followed. And then lastly, I will also mention some formulae that some mathematical formulas that arise from this. And then lastly, I will talk about the many arguments that my perspective has against any form of non free banking, such as government regulation, especially central banking, which I will discuss at length. And I will lastly talk a bit more about dollarization, because that seems to be an alternative that is proposed sometimes to central banking, but it's actually worse in every single way to free banking, which I will also explain later. So, as you may know or may not know, the free banking perspective is almost uniquely defended by the Austrian School of Economics. But even then, it's not really a monolithical conduct, because there are three different views held within the Austrian School of Economics as to how the free banking system should look like. The first model that is probably the most popular one is the Mises-Rothbard model, is how I'll call it, which is free banking that also includes full reserve banking as opposed to fractional reserve banking. The second model is the Hayekian model from Hayek, that is very similar to how cryptocurrencies work today, in which case, yes, you give all the freedom to issuers of money to do with it whatever they want. And additionally, there is no universal standard in which this money should be redeemable. However, the third model is actually the model that I'm defending, which is the Lawrence White, George Selgin free banking um, structure, which still includes fractional reserve banking. The other economist who is an adherent of this model is Larry Sackrus, that I added a little bit down below there. But yeah, those are the three models. I think the model that I'm defending, the last one, is the least represented model. And my best, the best idea I have about why the model that I'm defending is so little represented in the economic literature is simply because um, a lot of people, and especially a lot of economists, just don't seem to know how money could or should work. They hold on to certain economic ideas, I think, because they're, as I would like to say, they're way more idealistic than they are realistic. And I hope that my arguments against other forms of banking, including other forms of free banking, will actually help you understand my perspective and why I think that other economists or other people that are economists just don't seem to know or don't seem to want to know how money works or could and should actually work. So without further without further ado, um, first I'll provide this theoretical summary of free banking. However, the very first thing I will do is actually explain how a monetary system develops out of nothing. So, um, a monetary system, before it really exists, before money exists, an economy is essentially a barter economy. You
Yeah,
know,
so people exchange goods and services for other goods and services, typically consumables, but occasionally uh, more solid commodities.
yeah, you could have different farmers who are trading cattle or different kinds of agricultural goods. And it's just, as you mentioned, a direct exchange of different goods that are meant for, well, ultimately, usually meant for consumption. But of course, barter already breaks down in an economy of, let's say, three farmers, where two of the farmers they would like to trade, but they each don't have a good that the other wants. And in a situation like this, money essentially has to be invented, not a direct, but an indirect means of exchange, and well, also a unit of account. You have to be able to denote the every other good in the economy in some kind of units that is universal, used for any good in that economy. So in this case, yeah, indirect means of exchange will arise, and these there are certain characteristics that are useful for money to have, and those three characteristics are first of all durability. You want to be able to save money, and if you drop it, you don't want it to break that easily or go filthy that easily. Homogeneity, of course. You want, sorry, homogeneity. You want a certain instance of money to be equal to another instance of money of equal size or equal weight. And lastly, divisibility is also very handy because you want to be able to divide your instance of money. So eventually, the goods that hold these characteristics more than any other goods will simply drive out these inferior kinds of money out of circulation. And what we would typically end up with is these precious metals, as you can see on the top right here. Silver, gold, perhaps even copper are the goods that best hold these characteristics. And yeah, they will remain as the universal means of indirect exchange as the monetary sector of an economy or a society develops. At this point, of course, as you may or may not know, gold and silver are fairly heavy. And also, if you have this monetary sector that keeps developing, eventually you will have these universal gold or silver weight standards. Like you would have gold or silver coins for certain amounts of gram. that are used to be exchanged. So in order to first perhaps stash the gold somewhere, because it's a heavy thing. If you have a lot of gold, it's hard to travel. Or otherwise, you want to turn your gold that might be very crude or raw into these universally accepted coins that are easier to measure and therefore to pay things with. These golden bars or whatever you have will be deposited at goldsmiths.
Yes. Well,
And
that's what began to happen, as far as I understand, in medieval Europe going into the Renaissance.
yeah, and from this deposit at goldsmiths, two important developments in the monetary sector arise. Firstly, goldsmiths discover that they can, the way it works, of course, is you will get a receipt for the gold that you have deposited, and because of convenience, these receipts, instead of the gold that you can withdraw from these receipts, will rather be used as the money essentially, because it's backed by the gold that is deposited there, and of course it's less heavy, it's easier to carry or travel with, it's more difficult to steal. If someone would just be walking around with gold, it's you're more of a target, I would say. So yeah, for these reasons, the receipts that back the stashed gold will be used as money instead of the gold itself. And what goldsmiths will also realize is not every person that stashes gold at theirs will be looking to withdraw that gold on the same day. So there will always be reserves that are held at the goldsmiths, and therefore they only have to hold a fraction of the actual full reserves that are deposited at theirs as reserves, and the rest they can just loan out for interest, which in turn becomes the income for these goldsmiths. You see, first, when um, if they wouldn't do this, then the gold that is stashed at theirs is essentially just warehoused. And at that point, the goldsmiths don't act as banks, but rather as warehouses. And of course, warehouses, when they issue receipts, they also issue fees to the people that have stashed whatever items they have stashed. So instead of having to pay the goldsmith to stash your gold, instead, the goldsmith will actually pay you for you to stash your gold at this goldsmith, because they already have an income from the interest they can get from loaning fractions of their gold reserves. And yeah, therefore, fractional reserve banking is invented in this case. And that, of course, makes the monetary system way more efficient, because um, the money is again loaned out for economic developmentary purposes. And so, of course, as the monetary system develops and the trust in the goldsmith receipts grows, and also because of the added convenience of using receipts instead of instances of gold, the initial gold and or silver money will eventually be driven out of circulation in favor of the receipts of these goldsmiths. And at this point, you could say that, well, goldsmiths are essentially banks now. The receipts that they issue in exchange for the gold that is deposited at theirs is bank money, and the gold or silver that acts as a monetary base will I will henceforth is what I will henceforth call base money. So eventually, all the base money would be out of circulation. The only money used in the economy is just the bank money that is issued by banks. And it is at this point that I would call the monetary system or the banking sector a mature system.
Yes. So, as an illustration here, using the pictures on this slide, the base money could be compared to, uh, let's say, if there's a gold standard, the base money would be the gold itself, as seen in the picture, and the bank money would be the banknotes produced by uh, the banks that are redeemable in gold, although typically speaking, they would be traded without being redeemed unless it became necessary.
Yeah, pretty much. But of course, different banks are in competition with each other. Um, so this is where, um, actually, let me first say one more thing about the bank money that would be used in this kind of system. As you may or may not know, bank money essentially functions as a call loan. Um, the bank notes that a bank prints or yeah, well issues are essentially the liabilities that mirror the assets that is actually the base money reserves that this bank holds. And of course, a bank, especially when it is not in a mature banking system yet, it has to sort of estimate how much bank money it can print, such that not too much bank money will be redeemed within the coming period of time, such that the bank wouldn't have enough base money to be able to have it redeemed for the redeemed bank money. And another important characteristic of this money is that um, it will be the case that bank money can have this suspension clause that is stipulated as follows. If a bank, if a customer comes into a bank to redeem the bank money, but let's say the bank doesn't have the base money at hand to make that redemption happen, they are able to suspend this redemption up to a predetermined amount of time, let's say a few months. And in exchange for invoking this suspension clause, they would have to pay an additional penalty interest rate in addition to eventually redeeming the amount of base money that is redeemable for that bank money. Now, of course, the penalty interest rate would not be the only cost that the bank would have to pay. This would also lead to certain reputational costs. So this clause would be used sparingly. Nevertheless, it would be used if the bank would be, let's say, illiquid at a certain point of time. And we've seen this sort of stipulation historically. The primary example that comes to mind is the Scottish free banking system, where such stipulations would be able to suspend redemption for up to 6 months. And yeah, it was just a thing there. So it appears to be a characteristic that could naturally arise from a free banking system. Then, of course, the bankers themselves, as I said, they engage in fractional reserve banking. Um, I think now it would be good to explain why fractional reserve banking in a free banking system is a good thing and why full reserve banking is actually the inefficient version of banking, especially in free banking.
Yes,
So,
I think this is an interesting point to make because typically a lot of people, at least in uh, the Austrian economic sphere, have a negative opinion on fractional reserve banking. However, I would emphasize that this is primarily related to fractional reserve banking when it is performed by a central bank rather than smaller banks.
Yes, yeah. The the problem indeed when it comes to fractional reserve banking is when it is done under central banking as opposed to free banking. And I hope the following explanation that I can provide serves to inform the viewers a bit better on why fractional reserve banking is not inherently a undesirable characteristic of banking. So everybody knows how banks make their money. They serve to be intermediaries between short-term deposits and long-term loans. Um, so in a full reserve banking system, where you back every, let's say, every instance of bank money to every instance of base money, um, essentially there is zero risk, right? There's no way to be illiquid. There's no way to be insolvent unless you're, of course, cheating this full reserve banking system. But this is not the optimal way to be a banker. It's not a taking on zero risk is not how businesses how businesses work. Businesses will always look to have as less risk as possible given a sufficient return that justifies the amount of risk that they're taking. And when banks are intermediating deposits and loans, they're taking on as long as they're being as long as they're not being too risky with what loans they're granting and with how many loans they're granting. They're just looking to have the least amount of risk given a justifiable amount of return. Additionally, under fractional reserve banking, as we as we usually have seen historically, there are um, usually sufficient amounts of fractional reserves still held as reserves for these banks to be operable. What we see is that there's way less money actively redeemed from banks as opposed to how much bank money there actually is. Historically, in the free banking system in Scotland, free banks were able to survive on um, base money reserves as low as 1 to 2% just fine. And even now, banks operate at around, I think it's around 20% reserves. And yeah, it seems to be the case that banks are able to be operable at low fractional reserves while being able to make any redemptions happen with no problem. Another thing that is important to note is that demand for a loan can be a form of voluntary savings if the money that is loaned out to this person that demanded it does not use it for immediate consumption. So, for example, if someone would take a loan from a bank and they would use that loaned money to invest into some um, future, some long term endeavor that has a higher future return, it's essentially as if he saved up that money himself and then paid for it. It's just now the bank is able to speed up that process for this person uh, simply by the intermediation that this bank does with using the deposited money. Of course, if this person would use loaned money for some immediate consumption, yeah, this would not be the case. But then, yeah, this person would be at a big penalty. because yeah, he's not generating any return with the loan that he's initially taken, and now he still has to pay that loan back. And this person wouldn't probably take that loan in the first place if he had enough money to do or buy what he wanted to do with the loan's money. So that would just be a mistake on the person that loans, a mistake at the side of the person that loans the money, or perhaps the bank that didn't sufficiently research if this person would do something worthwhile with the loaned money.
Yes.
Um,
So essentially, when it concerns risk in whether it is safe to invest into a bank or for a bank to loan money to a particular person. Uh, there developed systems of reputation. Um, so, of course, banks themselves can have a good reputation for uh, not being extreme in their risks leading to insolvency. Likewise, persons can have, and businesses can have reputations like that as well. And therefore, I think one thing that people can put as a point of criticism is when certain governmental policies may lead to a situation where uh, the private sector is incentivized to ignore the reputation of persons or businesses in order to force a particular economic outcome, which can, as you mentioned, lead to those problems with insolvency and other things.
yeah, indeed. That's also something I will discuss later, the enabling of risky and even overly risking banking behavior by certain government regulation. Um, but yeah, so as people may know, and even a lot of Austrians that are for full reserve banking will be in agreement with, is that when savings go up in a society, the natural interest rate goes down. And as I just said, loans can also be a form of savings if those loans are used for future investment, because it's essentially a sped up process of a person saving more to be able to invest in the things that he wants to invest in for a higher future return. And also, a loan demand is essentially a increase in demand for the money in question. So being able to provide loans to people who demand these loans makes it so that the money supply is adjusted to the money demand. And as I just said, interest rates are better able to track the natural interest rate this way. If those instances of money are used to do future investments, so more savings, you want the interest rate to go down, and that happens when there's more supply of loans being able that banks are able to give out. And the full reserve banking simply does not function that way. If you have full reserve banking, and let's say you have a certain amount, a certain portion, a significant portion of customers of one bank that suddenly decide to save more, that doesn't mean that this bank can then loan out more of that saved money to other customers, because that's not how full reserve banking works. You cannot, loan out money that is not initially backed by whatever is deposited to customers that are not doing that additional saving. So I hope that's a very clear concept. Um, Again, if you have a significant portion of customers for a bank that are saving more, that should mean that for the bank overall, the interest rate should go down, which happens if there's more loanable funds. But if the other customers that did not initially save more demand loans, they cannot get it from the more deposited money of the customers who do save more. So the full reserve banking does not accurately track the natural interest rate the way fractional reserve banking would do in this case. The other problem is that, again, in a full reserve banking system, the bank acts as a warehouse instead of a bank, because essentially the money reserves, the deposited money is being treated as this warehoused item, and in this case, the bank would issue a fee to the people who deposit their money at this bank. And not only are people clearly more incentivized to put their money at a bank where they receive an interest payment rather than pay a fee for it, especially in the case of cash money, there is no way for banks to properly track who is supposed to pay the fee payments on the cash money that would be issued by this bank if it would be redeemable in some form of base money that is initially deposited, typically under a gold standard or something, which again, Austrians are fairly in favor of. Lastly, a problem with full reserve banking is that small coinage change simply doesn't work. So what I mean by that is like these small, let's say, um, coins of 50 or 10 cents. Under a full reserve, um, under a full reserve gold standard banking, these coins would have to be made in the base money itself. So let's say gold or silver. And I did the calculations for this in my work. And if I can find it real quick. Um, Essentially, if you would have this is for euros, if you would have a 50-cent golden coin right now, the size of this coin would be 0.00052 cubic centimeters. So it would be impractically small, the coins, golden coins of value 50 cents, for example. So you would have to use other material that has the same amount of value, right? Like copper coins or nickel coins
Yep.
would be used. But again, this would no longer be a full reserve free banking system, because if the relative price between gold and nickel or gold and copper changes, then the coin, these gold and nickel coins would also have to change in size. So you would have different sized coins where 5 cent is written on them, and you no longer have a full reserve free banking system. So the
Yes,
system will break down.
and
Okay.
it would also impact the circulation of those coins as well. For example, what can be seen in Roman coinage is when the proportions of gold inside coins changed, the ones that had more gold would be taken, and they would be taken out of circulation, uh, even though their nominal value would be the same as the new coins, but they were instead hoarded away, and therefore the money supply of those that were not reminted was essentially lost to the economy. Um,
Hmm. Yeah. So to wrap it up for full reserve banking versus fractional reserve banking, I argue that in fractional reserve banking, money supply adjusts itself to money demand, and interest rates track the natural interest rates, and therefore the money multiplier, which is the multiplier of bank money compared to base money. If there's, let's say, um, 10 times more bank money of a bank than there is base money, then the money multiplier is equal to 10. So the multiplier, money supply, and the bank lending rates track money demand, natural interest rates, and the competitive money multiplier. And under full reserve banking, that is simply not the case. You cannot loan out deposits from certain customers to other customers, which yeah makes it such that these adjustments simply don't happen. Um, this actually ends it. Well, okay. The other thing about banker behavior is the fact that bankers, since they're in competition with each other when it comes to the money they have in circulation, if a certain bank receives bank money from another bank by one of its customers, either through this customer depositing that money or repaying a loan with this money, a banker will always look to redeem bank money it receives from other banks at the other bank, yeah, whenever they can, essentially. They want the extra base money that also makes their own bank more safe. They're able to create more bank money out of that base money. So they'll always be looking to make the redemptions happen whenever they can. And this is actually the opposite to a customer. So customer behavior in this free banking system, especially when this free banking system is mature, is they will typically not be looking to redeem their bank money into base money simply because of the fact that the economy at that point is already adjusted to the bank money itself. It would probably be pretty hard to find shops that still accept base money payments like gold. All the different places where you can pay in the economy will just accept bank money, not base money. So for that convenience, customers typically don't redeem their bank money into base money. They would only do so if they no longer trust the bank that they are a customer of. And at that point, they would just be looking for another bank to immediately deposit their base money in instead. And they would be a customer of that other bank instead in that case. So as long as each person who wants to participate in the economy has sufficient trust in one of the banks in that system, the free banking system is completely functional, as opposed to probably a central banking system. If people in an economy that has a central banking sector don't trust the majority of the banks in that economy, then I think that would cause a lot more problems. But that's simply not the case in a free banking system. So now I'll talk more about further developments of a free banking system, especially after it has matured, so to speak. So, as I said previously, bankers will always be looking to make the redemptions for base money happen whenever they can, and because of that, these redemptions will first happen very inefficiently. So they will happen at infrequent times, and it will be the gross amount of bank money that ends up in another bank. So, for example, if you have Bank A and Bank B, it could be the case that in the morning, Bank A receives 100 units of Bank B money, and it will simply still in the morning, the Bank A banker will simply go to Bank B and redeem those 100 units for the base money, and yeah, would have to transport that base money back to Bank A. But perhaps in the evening, a customer of Bank B repays a loan there with 100 units of Bank A money, and then the opposite would happen. And it's clear that this is just inefficient. What could be more efficient instead is that different banks simply hold meetings with each other at regular predetermined timings to instead redeem the net um, bank money that it holds from other banks. So if Bank A and Bank B decided to meet on the day after when these loan repayments happen, there would simply be no transfer needed among these two banks because the net bank money that each of the banks has from the other bank is equal to zero. And these meetings would typically happen at clearinghouses. This is where the interbank clearings happen. So again, the clearing is redeeming bank money that you have received from other banks since the last clearinghouse meeting. And yeah, that's the initial function that clearinghouses would have in such a system. But there are also other benefits that clearinghouses can offer to the banking sector. First of all, the different member banks of a clearinghouse can just store their base money at this clearinghouse. The clearinghouse can function as a credit information bureau where all the different banks can show through documents what persons from the economy are loaning from them. So it can be clear which people are loaning from multiple banks and not paying their loans back, or just simply have a bad history of paying the loans back. So banks can be more um, prepared for certain customers that are not trustworthy or will not pay the loans back. Um, Clearinghouses can also issue their own credits instead of the base money that they store. So even though um, the base money will change hands in ownership, the base money doesn't necessarily have to be transported. It will just be stored at the clearinghouse, and each bank just holds an amount of credits that are backed by the amount of base money stored at the clearinghouse that they own. And of course, clearinghouses, um, it's just a voluntary union of certain competing banks, as opposed to this all-encompassing, like government mandated kind of union of banks. Like you can have clearinghouses that potentially have all the banks in the sector coming together, but it could also be only a select few, um, because each clearinghouse can set its own financial soundness standards for its member banks. Clearinghouses can police their member banks for financial status. Um, because of these, because of such standards, bank money is essentially valued binarily when the monetary sector is developed by this much. And this is simply the case because, as we will see later, and as I will explain more in the theoretical model, either bank money from a certain bank is valued at or very near par by the other banks, or it is just not valued at all, like it's a zero valuation. And this zero valuation quickly arises when a certain bank um, is not adhering to the financial soundness standards that its clearinghouse or its multiple clearinghouses are imposing on them. So if there's something wrong with a certain bank when it comes to financial performance, and especially when it comes to being able to oblige to interbank clearings or just bank money redemption in general, the clearinghouse will be quick to notice. And at that point, the other banks from the clearinghouse that notice will quickly know that this bank is not financially sound and will just not accept that bank money at all, even not anymore from their bank's own customers if they would repay loans with the bank money of the bank that seems to be financially not sound. But what can happen though, in case the bank is simply illiquid but not insolvent, is that this bank can loan base money at penalty rates at the clearinghouse. So this is sort of the privatized version of a lender of last resort kind of thing, where it would only happen if the bank is illiquid and not insolvent. Um, and the thing to underline here is that a clearinghouse would be an incentive compatible establishment uh, of different competing member banks. Unlike how central banks are formed, as we will see later, central banks are formed through legal privileges. But as I hopefully have explained somewhat sufficiently, as you don't need such legally privileged central banks to have these institutions, these monetary institutions emerge where banks can come together and make sure that financial soundness is enforced on the competing member banks of such clearing houses.
Okay, I think this is a good place to ask a question that I have had after reading your thesis. What if the banks, for example, the member banks of a particular clearinghouse, try to form a cartel to reduce competitiveness or to otherwise manipulate the financial sector?
So this would be a cartel that, for example, would engage in, let's say, they would all print excessive amounts of bank money, and they would still, as a cartel, accept their money at par.
Well, it could be that perhaps they try to exclude new competitors from rising uh, in the region in which they operate, or so to essentially only accept the banknotes of particular banks and refuse those of other banks, even if they would rise up to standards, good standards of banking, things like that. That would be one example. Or if they tried to uh, be deceptive about the total amount of money that they put into the economy when interacting with, let's say, a different clearinghouse. Things like that, where they come together as a group in order to either secure themselves a place in the financial market or to reduce competition or to otherwise manipulate their advantages against other groups. Uh, as there certainly is a potential for that, but how do you think that the market would respond to that?
Yeah. So the beauty about having a universal monetary base for which the bank money has to be redeemable is, let's say that you have a certain bank who is not whose bank money is not accepted by the other all these other banks, but this particular bank still accepts the bank money of all these other banks. Then it will quickly have the other bank's bank money, and it will be able to redeem that bank money at interbank clearings. And even then, um, if other banks don't accept the bank money from this bank as a bank, they would still be contractually obliged to be able to redeem their bank money from this bank as a customer. And at that point, the bank would still just essentially get significant amounts of base money from all these banks that are forming this cartel until those initial cartel banks realize they have to accept the bank money from this initial bank. This is, of course, assuming that this initial bank is financially sound and able to, yeah, remain in business, so to speak. Um, Also, clearinghouses, there can be multiple clearinghouses within the economy. And these clearinghouses can, of course, be in competition with each other, which was actually the case in Sweden, for example. There were two clearinghouses in Sweden for the second half of their free banking periods, which were in competition with each other. Um, and then, of course, you can show to the banking sector whether you have and strict or sufficient financial soundness standards for your member banks, or you don't. Because if you're a bank, and let's say you are a competitive bank, you want to be competitive, you would want your clearinghouse to be strict with very reasonable financial soundness standards, because otherwise you might be doing interbank clearings with other banks that are not competitive and maybe not even financially sound or anything. So therefore, it is incentive compatible, at least for competing banks, to be able to develop clearinghouses that, provides sufficient financial soundness standards. And again, if the clearinghouses with lousy standards emerge and they don't accept money from certain banks, as I've said, for the reasons I've said before, such banks would be able to just get a lot of the base money from these cartel forming banks instead.
Yes. In conclusion, the problem of a cartel would be more likely to resolve itself the longer the time is.
Yeah. This would not happen in the case that you have a clearinghouse that sets high financial soundness standards, and then there's a bank with, who doesn't seem to be financially sound, and you no longer accept it because in the long term, since this bank is financially unsound, it will probably, go bankrupt, will, be insolvent, right?
Okay.
So any bank that is not accepted by a central, any bank that is not accepted by a clearinghouse, so to speak, would eventually, get a lot of base money from the banks from that clearinghouse. But this long term doesn't exist if the bank is financially unsound in the first place, right? So that's kind of how it works. If it's sound and it's able to exist for a longer period of time, then it will slowly get all that base money from the members of that clearinghouse.
Okay.
Okay, that's first part of the theoretical summary. I've already talked about the clearinghouses as an additional private banking sector development in free banking. And now I'll talk about perhaps a very interesting topic for people who only know a bit about free banking, and that is monetary policy in free banking, which might sound like a contradiction in terms, right? As I said, there is no government dictation, um, but a monetary policy is actually sort of possible under the free banking that I defend, but it's only a very specific kind of monetary policy. But before that, I will first quickly have to highlight what I like to call the Achilles heel of free banking as it has been historically. So the thing about free banking, and this is something I will actually highlight mostly a bit later when I talk about the model. It's that it regulates the amount of bank money in the economy very well. But the thing it cannot and does not regulate is the amount of base money in the economy. And the bank money still derives its value from the value of its base money. So if you suddenly have a large influx of base money in a free banking economy, then that would lead to like a hyperinflation that the free banking system simply doesn't have a measure against. Another example that I found in the literature, well, a hypothetical example is if England, for example, had a copper standard during the time when um, the the engineers in England found out that you can use copper when as a as material to build ships. There's certain parts of ships. I
Yes,
forgot what it.
lining
Uh,
on the underside of the hull.
yeah. If that would be found out under a copper standard, then suddenly a lot of there's this huge demand, huge industrial demand for copper, such that there's going to be way less copper available for banking, and there would also be a massive deflation of the bank money because yeah, now the thing that backs this money is way more valuable. So if we are able to sort of regulate the amount of base money in the economy, we would essentially fix what I call the Achilles heel of free banking. That is, yeah, not having any high volatility or sudden fluctuations in yeah base money amount or value. So, of course, I hold the position, just like any Austrian economist would do, that uh, we don't want any kind of discretionary monetary policy from some central bank or government official, but rather what I'm proposing here is the need for a strict, robust monetary rule.
Yes, and before you go further, for those that don't understand what a discretionary monetary policy is, that would be a system wherein the base money could simply be inflated by the government whenever the government deemed it necessary, typically in order to promote investment during economic downturns, as is seen, for example, in a large amount of inflation in the dollar supply following the coronavirus pandemic. That's a very recent example. But there's other examples, not only throughout US history, but throughout the history of very many countries.
Yes. So that would typically be a fiat based money.
Yeah.
Having gold or another metal as your monetary standard is what I've referred to now a few times. It's called a commodity money. And yeah, uh, in a bit, I will talk about the kind of base money that would make it possible to create a monetary policy under free banking. But yeah, I'll first talk about
Yes.
this monetary policy in and of
And I'll
itself.
say the discretionary monetary supply is also possible under the gold standard, as I believe is seen during either it was the reign of one of the Roman emperors. It was either Augustus and Tiberius. There was an incident with a ship with a large amount of gold sinking in the Red Sea. So the emperor took from his personal gold reserves and minted those in order to offset the loss of gold from the shipwreck.
Yeah. So, yeah, what we need is a strict and robust monetary rule. And strict in this sense means that the monetary rule is enforceable, and robust means that it is effective. And there are different ways that you can pose how a monetary rule is enforced. But of course, putting it under the discretion of a central banker or a government official doesn't make it strict. What I propose is that some kind of constitutional amendment has to be made that simply makes that monetary rule strict, and there is no authority that can arbitrarily decide whether to enforce that monetary rule or not. Secondly, is of course the robustness. This monetary rule has to include monetary variables that are under direct control over some kind of authority. So, for example, a monetary rule that includes employment would be not robust. because employment is not really a variable that is under direct control of monetary authorities. There are things such as, I think it's called systemic unemployment. So a lot of kind of causes that are very hard to control for or to impact as a monetary authority to control the amount of unemployment. But as will be understood shortly, what could be a direct control variable is the amount of base money in the economy. Um, so what would be ideal is being able to set the base money in the economy such that it changes in proportion to, for example, the size of the economy. So the GDP, the nominal GDP size. So for a given size of the economy, the level of income and spending, at least the amount of base money that the income and spending backs would be the same, essentially. Because, yeah, as a economy grows, you would expect there to be more products, maybe perhaps also more people in that economy that, yeah, would spend or save. So, yeah, that's the reasoning why you would want a growing base money supply when the economy grows and a shrinking base money supply when the economy shrinks. But of course, I also would argue that if the the way to estimate the GDP is in itself not sufficiently robust, or there's no universal perfect way to estimate GDP, perhaps the best variable to set the base money in proportion to is population size. You would typically expect if the population size of a country increases, that the aggregate level of income and spending would have to increase, or at least the base money that backs this income and spending. And of course, population size is a very easily estimable figure for the government, for example. But then, of course, this leaves the question: how can you regulate the base money of the economy? And this is where I introduce what I like to call synthetic money. So, synthetic money is called this way because it synthesizes the desirable characteristics of both fiat money and commodity money. So what's desirable about commodity money is, of course, that it is naturally scarce. It has an inherent value because of its scarcity. But what is undesirable, however, is that commodity money has industrial uses alongside monetary uses. So, as I said previously, there can be changes in the demand for industry for this kind of money that could inflate or deflate the bank money that is based on the commodity money in question. The ship example, as explained previously. And also, if the technology to mine gold, for example, improves, or certain kinds of new areas are found where gold can be mined, that influx of commodity money would result in a bank money inflation that would not be correspondent to keeping a level amount of income and spending given the economy size.
Yes, and I
Um,
think a couple of examples of this are historically gold mining in Australia
yeah,
led to that type of problem. Another, uh, perhaps more famous example would be the Spanish conquest of Peru, led to an enormous amount of gold and silver entering the Spanish as well as the wider European economy at the time.
yeah. I've read a bit about the Australian free banking experience. It was very short lived because yeah, as you mentioned yourself, the gold mining there quickly resulted in massive inflation of the bank money, and therefore the free banking system quickly collapsed. And also for that reason, it was never adopted again because the Achilles heel was thoroughly damaged of the free banking experience there. But this is where yeah, that's the good and the bad side of commodity money. The natural scarceness is good. The industrial uses is bad, not only for the reasons we just mentioned, but also because essentially having more commodity money for banking or monetary purposes also decreases the amount of industrial use that could potentially, be an effect from this commodity money.
Yes,
But
or another way to put it, the more gold you have in banks, the less gold you can put in computer circuitry, and vice
yeah,
versa.
yeah, pretty much you have to distribute among different uses. That could be seen as a waste or yeah. And then the opposite, of course, to commodity money is the fiat money. And the good thing about fiat money is that it is only used for monetary purposes. There's no industrial use for it. So the possible shifting demand for industrial use of fiat money doesn't exist. There's no industry to waste fiat money on, so to speak. And there's also no other need for fiat money in industry that would make you think that any fiat money used for monetary purposes cannot be used for any other purpose. So that's the good thing about fiat money. The bad thing about fiat money is, of course, that it's not naturally scarce and subject to the discretion. So it doesn't have any inherent value. And if if fiat money wasn't backed by, for example, the fact that it's legal tender, among other things, it would simply fiat money. Um, if fiat money was left to a laissez-faire banking system, it would simply be worth the paper that it is printed on, which, that would be a worthless paper standard. So if you combine the characteristic of fiat money to not have any non-monetary uses and the characteristic of commodity money that it is naturally scarce, you synthesize these two characteristics, that's when you get synthetic money. And a good example of synthetic money is, I have it here on the top of my screen, cryptocurrencies such as Bitcoin. Because as you may or may not know, Bitcoin is designed to only to never increase in supply beyond 21 million Bitcoins. And also, I mean, cryptocurrencies are essentially they only have a monetary purpose. There's no other use for cryptocurrencies. So yeah, Bitcoin is a very good example of a synthetic money. But of course, it wouldn't the synthetic money that could be used for monetary policy wouldn't be designed to only not surpass 21 million coins. What would happen optimally is you would design such kind of synthetic money such that its supply is set in proportion to either the size of the economy or population size. Whatever you think is the better
Yes, and
decision there. Yeah.
and that's to maintain the stability of purchasing power and prevent either hyperinflationary or hyperdeflationary situations from arising.
Yeah. The formal reason is to have a level amount of income and spending given the size of the economy. But yeah, it's pretty much what you said as well. So the changes in base money are such that the value of the bank money that is backed by the base money remains stable given changes in size of the economy. Um, so what would happen? Like you would only introduce synthetic money in a mature banking system, of course. Um, so at that point, only banks should have base money, at least base money for monetary purposes. So what you do in that case is you design the synthetic money the way I just explained it, and then all the banks that are still operational, or yeah, that are in effect operational, you give them a wallet and you give them the proportion of synthetic money that you're handing out equal to the proportion of base money that they currently hold in the monetary system. So yeah, you swap proportionally, yeah, the previous commodity money, commodity based money for the now new synthetic based money for every bank, and yeah, they would just operate exactly the same way henceforth. So the benefits here again, not only the fact that the base money supply is now changing exactly the way it desirably would, given the size of the economy or the size of population, but also the fact that if base money from one bank would have to go to another bank, these changes happen almost instantaneous now. So the transportation and time costs of exchanging base money among banks would be virtually negligible at that point. Probably a bit of electric power cost, of course, to because it's electronic payments. But other than that, um, yeah, the costs are fairly negligible. And of course, if changes in the base money supply happen, what that would imply for every single bank is that their base money reserve holdings would just increase or decrease correspondingly in proportion. So if base money would, let's say, for example, double because suddenly, yeah, hypothetically speaking, population or the size of the economy doubles, then the holdings of every base money would also, yeah, double in correspondence.
Uh,
So that's yeah.
yeah, I do have a couple of questions or points here. Uh, One is I imagine that, let's say, if we are converting uh, a money supply that is already a fiat supply to a synthetic system, what you would do instead of, let's say, exchanging the commodity for or giving the base money in relation to the amount of commodity they have, since it's not commodity based, what I imagine would be you would simply that the easiest way to do it would be to take the existing amount of fiat and simply put that in proportion to the base supply that is then given out. I imagine that would be uh, the
Yeah,
easiest way to organize that.
yeah. Um, yeah, I suppose so.
Yeah, A- and
Um,
and the other point or question I have is while you focus on Bitcoin and electronic transactions, I would imagine it would theoretically be possible to also have synthetic money, not necessarily as an electronic system, but in a system similar to banknotes with anti counterfeiting measures.
yeah, it could be possible. Yeah, that's for sure. Um, the thing that makes uh, money synthetic rather than fiat is you really make sure that um, there's no discretionary power anymore. So after you, for example, designed the synthetic money, you that like electronically, for example, right? You make sure that by some way you have to insert some password to be able to change the design, for example, and then you make sure nobody knows the password, for example. What Selgin promotes in the literature was you have a specific money that's like printed in some very unique way, and then you destroy the. He proposed something to do with the printer such that it couldn't be used discretionarily anymore. Um, but yeah, I assume it is possible though to have some form of synthetic money that
Yeah,
could be physical.
and I think that perhaps Selgin's approach to me seems a bit excessive. Uh, what would be easier to do would be to simply have strong uh, criminal measures uh, or strong criminal charges on manipulating the money supply in an unauthorized way, at least a way unauthorized by the monetary system. Uh, because, of course, if we are, let's say, using the printer as a model, so we're using in this imaginary scenario, we're using paper money that has anti-counterfeiting measures in it, sort of like U.S. dollars have. They have little strips and things like that. Uh, what you still have to do if we are saying that the base should change in proportion to the either the economy or the population, you would still need to print money in those situations under that system, and uh, and that means that you would still have to have a printer around unless you wanted to have an absolute limit, which of course would run into the problem that we mentioned earlier with deflation. And of course, Bitcoin or an electronic system, you would have to enter into it economy or population statistics in order to maintain the level. Uh,
Yeah.
so there is still some maintenance, I would say, that goes into any system that would be selected, and therefore I don't think that destroying the means that the system was achieved in the first place would be a good idea unless you went back to the idea that you want to have an absolute limit rather than a monetarist flexibility to adjust to the economy or population.
I suppose the you'd have a printer, but it would have to be designed in such a way that it only prints when the the population or the economy size increases, but then you would also have to have a designed measure that destroys supply if that would
Well,
decrease.
we live in a society, so I would imagine that I'm thinking in terms of simplicity. That is to say, I want to look at systems in terms of not being too complex technologically speaking, and therefore, in my imagination, it makes sense that this would simply have to be something that would have to be managed by people that would then have to hold each other accountable.
Yeah. All right.
Because if we lived in a society that didn't have complex cryptography or uh, complex printing technology and computers and stuff, then this synthetic system, if it relies on that, wouldn't work. However, I would say
Mm.
that theoretically speaking, if you look at it in terms of accountability between persons and establishing systems of accountability, it could still work even in a uh, less technologically sophisticated society.
Yeah. Sure. Mm. It would be, uh, yeah, that would be possible, uh, but it would be a bit. uh, how do I say, laborious though, I think. Because I'd argue all like the base money holders would have to lose that base money in proportion to decreases in population or yeah, or size of the economy, for example. But I mean, it is possible. That's something I won't rule out. Yeah, so that's, I mean, that's how monetary policy would look like in this free banking system. Of course, you're only regulating the universal base money standards. The fact that this base money has to be universal already kind of makes it a policy in the first place, of course. So that's also why I do not necessarily consider this monetary policy to be something that breaks the free banking aspect of it. Um, because of course, and I'll yeah say this very shortly. Like the one argument against the Hayekian free banking system, since I already provided the arguments against the Mises-Rothbard model that is full reserve banking. The argument against the Hayekian model is that you, yeah, first of all, it would be like this paper money standard kind of thing, because again, there's no base money that is like naturally scarce, for example, that yeah backs the value of the bank money, so it would only be worth the paper that's printed on. And secondly, there are no equilibria to be formed in such a system. At least there's no economist ever that made satisfactory equilibria in such a system, as we will see eventually is the case for the free banking system that I defend here.
Yes.
Um, so yeah, I'll move on now to what happens under base money shortages. So if a free bank is either liquid or insolvent. And this is actually one of my favorite parts of the theory because it just shows in how many ways the market corrects itself, so to speak. Because um, that's usually a thing that people are very critical about. Like, oh, if you have a free market, like, how will it correct itself? You know. But as I hopefully will show, the free banking system has ample ways to do just that. Some of these I already explained. Of course, you may remember the redemption suspension clause that banks could invoke on their bank money. This is something they would only do like sparingly and only if they're slightly illiquid at that very moment of redemption, of course, because otherwise they would suffer reputational costs and, of course, the penalty interest rates they would have to pay additionally. Um, if there is more base money, if banks are even less liquid, though, they would probably engage in the clearinghouse lending that I just explained. If the bank is able to prove it is not insolvent but just illiquid at the moment, they could just loan base money from the clearinghouse or other member banks from the clearinghouse, um, and yeah, use that in the short term and then have to pay back plus the penalty interest rate in the long term. Mergers and acquisitions are, yeah, they're very common even in the central banking system. So I mean, it's basically two banks merging with each other or one bank acquiring another bank. Um, As we will see later, there are economies of scale when it comes to the money multiplier. So basically, um, if you have a certain level of base money and you have a certain level of bank money, if you double the amount of bank money, the amount of base money you would need to back that bank money would be only would only have to be increased by about the square root of that double amount, which we will sort of see later when I talk more about the formulas of the theory. But the most interesting event that could happen in case of base money shortages is the market share buyouts. So redemption suspension and clearinghouse lending only happens when the bank is liquid. When the bank is insolvent, but it's not too insolvent, it can be it can merge with another bank or be acquired by another bank. But the market share buyout is what would happen in the worst case scenario, so to speak. When a bank is just completely insolvent and there is no hope for, there's probably no hope for this bank continuing much longer. And of course, this would like quickly be realized by the clearinghouse and probably also some of the bank's customers. And let's go to such events. So let's say that news breaks out that a certain bank is completely insolvent and its customers know this. So what they'll do is, they will all go in unison to the bank and knock on its doors, and they would all want to redeem their bank money for whatever base money is left in that bank. And as you, yeah, in a fractional reserve banking system, yeah, it's clear that there will not be enough base money for all those customers to be able to redeem their savings. So it seems like a lot of customers will probably lose their savings, which is a horrible thing, of course. For the bank in question, of course, the owners of the bank will, yeah, they will suffer huge losses and go bankrupt, and also the other competitors in this banking sector. So this bank that is insolvent initially had some kind of market share, but it seems like this market share, rather than that the other banks in this market will be able to take over that market share, it seems that that market share will just evaporate and disappear from the economy, which is also not good for the other banks who would have liked to get some of that market share instead. So instead of this situation where it all comes crashing down for all the parties involved, what will happen instead is, as the bank that is completely insolvent still invokes the redemption suspension clause, so it doesn't have a period of time that it has to make the redemptions happen yet, even though eventually it would. In the meantime, what the other banks in this sector would have to do is they would have to notify the customers of the initial insolvent bank that they are that even though they cannot make the base money redemptions in the insolvent bank, what they could do is they could just take the bank money of this insolvent bank, go to the competitors, and exchange the insolvent bank money uh, for the bank money of all these competitors. So if Bank A is this insolvent bank in question, then Bank B would notify the Bank A customers that it can exchange Bank A money for Bank B money, and Bank C would do the same for Bank C money, and yeah, the same for Bank D, and so on. And what happens in this case is that the market share of Bank A, so the customers of Bank A, will simply swap customers to Bank B, Bank C, Bank D, etc. Yeah, they would simply take over the market share of Bank A, and yeah, that's in the best interest of the competitor banks. For the customers, it's better because first of all, they're not losing their savings, or at least not a significant amount of these customers will lose a significant amount of their savings. Instead, they will simply use the other bank's money now that is still yeah uh, backed and trusted to be backed by the base money. And also, even if they got their savings back in base money, the first thing these customers would do anyway is go to the first bank they trust the most in the system and just deposit their base money over there. So now they don't have to do this more tedious, more time consuming thing and just go to that trusted bank immediately instead and just um, exchange their insolvent bank A money for the bank they trust the most. And also for the insolvent bank A in question, this is the best, so to speak, because now at least it's not drawing these huge losses that it would normally would if all its customers would simply go to that bank to redeem, redeem the base money that bank A still has. what would eventually probably happen is whatever base money Bank A had left will probably just be distributed among the competitor banks in proportion to the proportion of Bank A money that all their competitors have received from their customers. And then, of course, Bank A would cease to exist. I mean, I don't think the reputational damage could be healed. But the bank sector just lives on in competition as it previously has. The market share of the faulty insolvent bank has safely been disposed of. The other banks took over that market share in accordance with how trustworthy those other banks are to the customers of Bank A. The Bank A customers don't lose their savings because now their money exists out of the other bank's money that is still functional, effective, and trusted in the economy. And yeah, that's how the market share buyout would work. So I would say even in the worst case scenario, the financial sector doesn't collapse. Um, as long as customers still have sufficient trust in one of the banks, and because every single individual bank is issuing their own money, it's simply, yeah, they're in competition with each other, right? It's like you go into a city and there are different restaurants, but now one restaurant appears to be having very bad practice, like they're using rotten food or they're very non-hygienic, and that comes out. It's like a major yeah, like a very bad thing that happens for that bank, but its customers will simply go to the other restaurants and simply continue on eating at restaurants. And the other restaurants benefit because they took over that market share. And it's the exact same story here. And in a central banking system, if one of the banks fails, especially a big bank, it's like every bank uses the same central bank issued money, right? Like it's the money itself that is less safe now because of whatever loans in that money or credits in that money is now no longer fulfilled because that bank that might have had a lot of loans in that money is no longer able to repay them or yeah, things like that, basically.
Indeed.
Okay, so this ends the description of the theory, and now I'll talk a bit more about the model, which I personally call the Selgin model because George Selgin, he's pretty much the leading economist of free banking, in my opinion. I've read him extensively, and I think he's the only economist that really, like, he develops this model firstly, and also think he's the only economist that really has written extensively profound and important yeah, descriptions about the free banking model. The vast majority of descriptions that I've gave you, I learned simply from him.
So, is
So,
there a particular book that would be good to read from Selgin on this topic?
he wrote this book, I think, in the late 80s or the early 90s, The Theory of Free Banking by George Selgin. That's a good book. Personally, I've read almost every single academic article that he brought out. So I would also, if you're interested in this topic, I would recommend you to read his articles. I also know that he has released two books that are essentially a collection of some of his articles. But to really be an expert, I would recommend you to read, yeah, all of his free banking related articles. Um, Even right now, there is this site. Wait, I can find it real quick. Yeah, it's called um, alt-m.org. Um, Ideas for an Alternative Monetary Future. This is a site where a bunch of economists, among which George Selgin, but also Lawrence White, they make they continue still to this day they make blog posts on this website. So I see here right now, actually, that Selgin made an article of 4 days ago on this website, so he's still active in writing blogs and articles. So he is the economist to follow if you want to know about free banking.
Okay.
Yeah, so the Selgin model first assumes rational behavior among bankers, and taken the description I've previously given to you into account, there are certain rational behaviors of bankers that emerge from that setting. The first one is what is called the law of adverse clearings. That's how Selgin himself calls it. So basically, if you um, so as I said, money has a supply and a demand for a given price level, and I have the law of adverse clearings here in front of me, so I'll just read it out loud. Um, any bank that supplies bank money in excess of its bank money demand at a given price level will lose base money reserves during the next interbank clearing meeting based on that excess amount. So yeah, essentially, if you as a bank issue an amount of money supply and it's in excess of the money demand, so basically the amount of money that your customers want to hold, they will keep spending it. It will keep being in circulation in the economy, and it will eventually end up at another bank where it's used to repay a loan. If it ends up at your own bank, and you would issue it again, that would keep the money supply equal. If you would then burn the money, that would decrease the money supply sufficiently to meet demand. But yeah, in an excess, it could lead to result in being ending up at another bank, and then you would suffer that amount of bank money as an adverse clearing in the next interbank clearing at the clearinghouse. So this, of course, limits the amount of money supply that each individual bank can issue in a free banking system. And the beauty about it is this is a natural and an enforceable limit on the bank money per bank, a limit on the bank money supply per bank. But of course, this law is not it's not perfect. It does not limit the base money injections that could still happen in the free banking system. As I've mentioned previously, that is the Achilles heel of free banking. But yeah, it does happen for the bank money, thankfully, because in a free banking system, there's multiple amounts of bank money that are issued. So it could very well be the case that there are customers of multiple banks. So you could imagine that each customer has like this portfolio of different kinds of bank money. And the kinds of bank money it demands the most will be the ones that this customer spends the least. So it will be quickest to spend the bank money that it least demands, which again plays into the whole supply and demand of different kind of firms thing that you could also find in other free market sectors. So again, if you supply in excess of what your customers demand for free banking, you will quickly lose your base money reserves to the other banks who do not do this in the next interbank clearing. But if all the banks in the banking sector maintain the right amount of money supply, roughly speaking, to the money demand, such that none of the banks seem to quickly be losing any of their base money. In fact, if the money supply of each bank is such that there is a zero long run expected value of changes in base money reserves, so market shares are expected to be roughly stable in the long run, while the money multiplier, so how many more times bank money there is compared to base money for each bank, is just low enough to correspond to an optimally low probability of them defaulting, given that there's still going to be random fluctuations around the zero mean that was expected to be of interbank changes. Okay, let me rephrase that again. So even though it is expected that uh, interbank clearings are going to be around the zero mean. So a stable amount of base money is expected for each individual bank. There's still going to be fluctuations around that zero mean. And for each bank in the sector, that means they still need precautionary base reserves for such fluctuations around zero mean. But still, in the long run, it would be expected that market shares remain stable, and therefore interbank clearings have a zero mean for a banking sector where each individual bank adheres to the law of adverse clearings. And if that's the case for all the banks in the sector, then we speak of a monetary sector equilibrium. And that's something I call this myself, because this is essentially a monetary sector wide equilibrium when it comes to keeping the market shares of this sector stable, roughly constant over the long term, even though there will be short term volatilities around that zero mean. Um, yeah, so that explains the monetary sector equilibrium. Then we still have the law of par acceptance. So the reason why in a free banking system, the different banks have to accept the bank money of other banks very near or at par is because of the following. I will read out again the law of par acceptance, which is what Selgin calls it. Each bank is required to accept the bank money of its competitors at par value, or they will experience adverse interbank clearance against banks that do accept theirs at par value. And this is equal somewhat, on average, it's equal to the discount that they impose on the other bank's money. That percentage amount of the gross adverse interbank clearings that are happening among these two banks. So, for example, if you have two banks, Bank A and Bank B, and let's say that Bank A accepts Bank B money at par value, but Bank B accepts Bank A money only at 50% of the value, then customers of Bank A are twice as incentivized to use Bank B money for deposits or loan repayments in Bank A compared to Bank B customers that are now half as incentivized as Bank A customers to repay loans or to make deposits happen in Bank B with Bank A money. So for this gross interbank clearing, we on average we could expect for the next interbank gross clearing to be 50% more Bank B money in Bank A than there is Bank A money in Bank B. So banks who do not accept other banks' money at par will quickly experience adverse clearings uh, against those banks. And this is why free banks are sort of rationally forced to accept each other's bank money at par. This is even the case for large established banks having to accept new market entrants at par, or otherwise they will quickly just lose base money reserves against those new entrants. Um, this is also the case historically. What you can see on the top right here is a board of, this was from some, I think it was the biggest free bank in Chicago in the free banking experience in the US from 1837 to 1863, kind of, before the Civil War. And what you can see here is that at the very bottom, so this is for the US overall, in total circulation, we have $150 million. But now, if you look at all the unlisted, doubtful, or unknown banks, their money supply amounts to about a million, and the amount that is discounted amounts to about 360,000. So even here, if you would have $1 from every single bank in the US at that point, and you redeem, you would convert all of that bank money into the money of that particular bank that set out this board, you would still retain about 99% of your value. So the par acceptance on average in the US back then was about 99%. There are some reasons why it wasn't at par, and those reasons are also in part due to the regulation that the government imposed on free banking at the time. If we look at other historical examples, such as in Scotland or Sweden, there was par acceptance among free banks. So this is a very historically a very yeah, a phenomenon that you can find. So these are the assumptions that you need to make to go further into the Selgin model. Um, the first important part of this model is the Edgeworth distribution. And this is called the Edgeworth distribution because Edgeworth was one of the first economists, you could say, that realized that there are economies of scale in something such as banking. If you, I don't know uh, if you want me to go deeper into the mathematical
For the
side of things.
purposes of this video, I don't think it's necessary to go too deep into the mathematics of it. Just simply explain the basics of what the Edgeworth distribution is supposed to tell us, essentially.
Sure, yeah, that's good. Um, so I provide here sort of a summary of the model. The sigma is the standard deviation of the Edgeworth distribution. This distribution is essentially the distribution of a bank's interbank redemption process. So again, we assumed the monetary sector equilibrium. So the mean or the average value of this distribution is equal to zero. But as I said previously, there are fluctuations among that around that zero, and the standard distribution of those fluctuations of that volatility. After you make the derivation of the Edgeworth distribution is equal to the right hand side of the most above equation that you see, where P is the price level, capital P. Capital B is the amount of banks in the banking sector, and capital N is the amount of transactions that are happening, and that includes interbank redemptions. So essentially, the higher the price level is, the more volatility there's going to be in the interbank redemption process, which is to be expected because higher prices imply higher possible fluctuations of bank money that could end up in other banks. Capital B actually decreases the volatility of this of the interbank redemption process.
So if
And
there's uh, more banks, it decreases the volatility.
yeah, and this is attributed to the fact that the more banks there are, the more competitive the system is essentially. That's probably the most quick and intuitive explanation I can give for that. Um, and lastly, the N, so the amount of transactions, which includes interbank redemptions or redemptions for base money in general. If those increase, then of course the volatility is going to increase. But as can be seen here, and I've done the derivation to this distribution myself as well from my thesis, there are economies of scale to be found here. As you can see, if the amount of transactions doubles, then the volatility only increases by the square root of 2, for example. So yeah, this is um, the precautionary reserves that each bank should have in base money should be equal to some multiple of this standard deviation. Because, for example, I think it's it's around 1.65. Yeah, if you take this standard deviation and you multiply it by 1.65, that would attribute to, let's see if I get it right. I think it was 95%. Yeah, like, well, actually, it's even, um, yeah, like 1.65 times this volatility in base money would imply that there's 95%. You can know with 95% certainty that you hold enough base money to survive the next interbank clearing without, yeah, having too little base money to make all the redemptions happen, for example.
Okay.
So that's how banks would think, or should, probably, rationally speaking. Um, then to move deeper into the model, the capital R is the amount of base money, which, yeah, could be called, could also be the synthetic money or the fiat in the economy. Small q is the bank's risk behavior, where you equate the marginal loan interest opportunity cost to the opportunity cost you forgo of making more loans. You equate that with the marginal base money shortage cost, which is basically like some penalty interest rate you would have to pay for invoking like a suspension clause or loaning base money from the clearinghouse. So it's essentially the interest rate income you could get from making more loans, the marginally, and you equate it to the interest rate you would pay from having, like, yeah, like being illiquid because you made more bank money. Um, yeah, this is the bank's risk behavior, and the larger Q is, the more risk averse a bank is, essentially. And as we can see in the base money equilibrium, which I call it so because this is essentially when the amount of base money in the economy is equal to the demand for base money in the economy. So yeah, it's like a market equilibrium of supply and demand for base money, so to speak. Um, what you see here is, so the amount of base money, and you divide it by the amount of banks, that has to be equal to the average risk behavior of banks times the volatility that they would expect, um, for what for which they need the precautionary reserves. And that intuitively makes sense, right? Like the average amount of base money that could be distributed among the banks has to be equal to the average amount of risk they want to take times the volatility that they're expecting. If you then move the variables a little bit, you get the expression to the right of what I just said, which is then the equilibrium total base money demand by banks in the economy. And if you then build further on this model, we can have that small y is the real output or real income of the economy, and phi is the proportion of real income to the amount of transactions. Um, phi, for example, could be seen as a time preference, like, um, yeah, basically, how if you have a real income, like how many transactions are you making based on the income that you just got. And yeah, at this point, it gets a bit more complex, I suppose. But if you rearrange the variables that you've got previously, you can get an expression for the price level, which, as you can see, increases. So this is the final expression. Its price level increases when the amount of base money increases, which makes sense. I've highlighted this previously. Base money injections lead to inflation. Um, it decreases based on how risk averse banks are, right? If banks are less risk averse, they if they are more risk averse, they will make less loans, so less injections of the bank money in the loan markets. And eventually, price level also goes down if the real output increases. So again, real output increase, so productivity increase. There are more products compared to how much money there is. So yeah, that would result in deflation. And lastly, again, if the amount of banks in the economy increases, that would also lead in reductions of the price level, because again, more banks implies more competition. And then the last further development of this model is simply introducing capital M as the amount of bank money in the economy and capital V as the velocity of bank money in the economy. And of course, I'll explain what money velocity is. Money velocity is basically the average amount of times that the money supply is being spent in the economy within a certain time frame. So let's say that you have, I don't know, like uh, $1 million as the money supply of a certain economy, and then the aggregate amount of spending in a certain month might be 2 million. That means that on average in that month, each dollar is spent twice. So the money velocity is then equal to 2. That brings us to the last equilibrium, which is the bank money equilibrium in the economy. And this one simply, again, very intuitively means that the amount of the money supply in the economy times the average amount of times that supply is spent has to be equal to the price level times the outputs. So yeah, basically all the goods that are being made and their prices, yeah, all these goods that are sold times the prices that they cost has to be equal to the money supply and the average amount of times that that money has to be spent on these goods. And so again, a bit of playing around with the variables happens at the very bottom here. And this here right here is the last expression that is equated to money supply. And the one important thing that has to be noticed here is that money velocity is inversely proportional to money supply. So what that means is if the equilibria are being held, if money velocity increases for whatever reason, there will be an inversely proportional decrease by the money supply as a result, as long as bankers are behaving rationally. So, because the M makes inversely corresponding changes in response to the changes in V in this bank money equilibrium over here, the capital P does not have to change itself, which is the price level. So price level does not have to change as a result of changes in the velocity of money because the money supply will actually adjust itself. This would not be the case under central banking because no matter what changes in the velocity of money would happen, the money supply would probably not be expected to decrease as a result because individual banks don't have to take into account the demand for their money and adjust the money supply to that demand, as we said previously, for the law of adverse clearings. And as a result, the capital P will have to adjust itself to the changes in the capital V. So price level would have to adjust itself to changes in the money velocity. If people, for whatever reason, suddenly spend their money twice as much, in theory, that would mean that the price level would have to double in a central banking system where there's no concerns for money supply having to adjust itself to money demand. That's the big takeaway from the model. To not go too much into further details that are not as relevant as this takeaway.
Yes.
So then we go to argumentation against multiple instances of non-free banking. The first one, of course, government regulation. Um, I'll first talk about a bit about why these regulations um, why generally these regulations are bad for the banking sector is because in some ways they actually increase the risk exposure of banks, and also because in other ways they reward risky bank behavior as opposed to rewarding simply the banks that are conservative in their lending policies and value being financially sound over profit maximization of giving out loans that might not be paid back for some reasons. So yeah, I'll first talk about branching laws, which were a thing even during the free banking experience in the United States. Free banking was state licensed, and you could not engage in free banking in multiple states. You were limited to the one state where you got a license to be able to start free banking. And the problem with branching laws in general and the a corresponding regulation like this could be argued currently is in the EU, because we have a the euro area, so all these countries in Europe that use the euro. It's not uh, it's difficult to create banks across borders of European countries, and that is also a form of branching laws in this case. And the downside of these laws is that it makes banks less geographically diversified. So a bank is very limited in the franchises or offices that it is able to create among the nation or among the state. And therefore, if the economy has a downturn in the limited areas where this bank was allowed to branch to, then there's going to be less opportunities for this bank to be able to grow. And also because then all of its loans are probably dependent on that area that is just facing an economic downturn. There's probably going to be a lot of loans it is issuing that probably are not able to being paid back in the short term. Whereas if a bank was able to branch out as much as it wants, it could probably be more diversified geographically, such that maybe some branches there's an economic downturn, but then simply in other branches where there's no economic downturn, um, funds could simply be transported to the offices that are finding themselves in a location that is finding a downturn. So it's just about being able to diversify geographically, because different geographic locations could have different yeah, economic situations. Of course, certain economies are very geographically dependent. I think probably, as you probably know, in the US, like some states are heavily dependent on certain industries and other states are dependent on other industries.
Yes, and some states rely heavily, for example, on importing things through perhaps more expensive means. For example, Hawaii and Alaska are somewhat disconnected from the other states. Not fully disconnected, of course. In the case of Alaska, people can still uh, drive a truck up into Alaska, but there's many regions of those states that are less connected than, let's say, the contiguous United States. And I imagine that's the case in any place that's geographically diverse, where uh, areas with mountains have different challenges to transporting goods, and also the types of goods people have are different, or an area where there might be uh, a large supply of mineable resources uh, is very different.
That's also a good point. Like if you have a very distant location and you have branching laws, then it's not going to be the case that a bank is going to establish a bank in that location and not being able to easily branch out to the rest of the country anymore. What you would want is a lack of branching laws such that other banks that are in the country and they're successful are perhaps able to create a branch that is somewhat closer to this um, location that is, yeah, very distant from the rest of the country. There was also an example that I've read from the literature that after the Civil War in the U.S., um, you there was a lack of banks in the in the southern states, and there were still some branching laws in effect, such that the established and successful the banks of the northern states were not able to branch out as easily into the southern states. That also resulted in less potential economic developments being realized in that time period. And I could argue the same thing for the euro area. If banks from the northern European countries, northwestern European countries that are more established and less risky, if they were able to branch out more easily into the southern European countries, perhaps more economic developments could be realized in those countries. Because there's more ample and less risky provision of credit and such. So yeah, that's the problem with branching laws. Second is high risk assets laws. So in the US, one of the cases that comes to mind after the Great Depression was the instigation of the Glass-Steagall Act that prohibited banks from holding certain high risk assets. And the problem of prohibiting banks of holding high risk assets is that even though these assets in and of themselves might be risky, when you put them into a portfolio with other assets that are less risky, and the uh, the covariance of the I think it's the covariance between these different assets are very low, that still means that your portfolio is better diversified than if you only have low risk assets and they have a very high um, covariance among each other. So yeah, that's why
Yes. So
prohibiting.
the low risk assets can compensate for the potential failure of a high risk asset.
Yeah, and the other way around could also be the case. If low risk assets fail, you could still have high risk assets that can make up for it if the covariance between them two, the correlation, that's actually what I should say. The correlation between these assets can be very low, such that if one does bad, there's a low chance that the other one also does bad, so to speak. So the portfolios are better diversified if you have both high risk and low risk assets, given that their correlation is low. So that simply exposes banks, that increases the risk exposure of these banks. And same case was for branching laws. But now for deposit, for deposit insurance, it simply means that this deposit insurance simply increases the risky behavior that banks could now instantiate because of potential moral hazard concerns. Of course, if your deposits are insured up to a certain point, why bother making sure that you have enough reserves for all these deposits at all times, right? And especially in the case of the FDIC, the Federal Deposit Insurance Company of the U.S., that federally insures deposits. Um, I think it's just a flat rate that is always being enforced. Whilst if you would like the equivalent of this in a free banking system would be lending base money from a clearinghouse, and still in the case of a clearinghouse, these penalty rates can be very adjusted to the certain conditions of the economy. So it's way more flexible as opposed to the FDIC deposit insurance rate, which is just a flat rate that is not competitively um, able to be flexible in that sense. Um, so yeah, then now it's time to talk about central banking, and particularly about the problems that it has. And I hope after explaining these problems, because I think this will be the first time for many of the viewers to even hear these kinds of arguments against central banking, to really yeah, think about what I'm about to say. But first, I'll start talking about the difference between free banking and central banking, because the case is actually many times historically that free banking evolves into central banking. And this typically happens after one free bank achieves legal privileges from the government, such that it can then become the central bank of the economy. And it usually happens because of an exchange between this bank and the government, where this bank gets the legal privileges, such as that only this bank's money from now on is legal tender, or this bank has a monopoly on money issuance now, or even say this bank um, no longer has to make any redemptions happen for base money. And in exchange for these legal privileges, the bank will favor the government in a way such that the government can always uh, be confident that it will get funding from this bank, and probably at favorable terms as well. So the usual incentive historically for a government to establish a central banking system is state financing, and in many cases, this pretty much amounted to war financing. In the US, for example, it was the Civil War actually that resulted in the downfall of free banking, because I think it was 1863, the northern states decided to impose a 10% tax on each free banking note that was issued, because they simply wanted to do away with free banking such that they could establish national banks and have more centralized points from which they could loan money for financing the war, the civil war in that case. But this could also be found in many cases throughout history, I would assume. Um, yeah. So again, if one bank receives legal tender status for their bank money in a banking sector, um, there is always going to be a natural demand for this bank's money, because, well, citizens will have to pay taxes, and if they have to pay fines, they can only use this bank's money. So, in fact, you could say, like, if there's like a yearly date on which taxes are paid for a certain country, um, the demand for this bank's money would skyrocket every single year for that date, regardless of how valuable or how well governed that bank's money actually is. And this will actually result, the fact that this bank's money is actually backed now by its legal tender status, will actually result in that other banks will stop redeeming all of this bank's money when they receive it, but will in fact store it alongside what is the base money still, like let's say the commodity money, as its reserves. Because each of the customers of every single bank has a good reason to at some point redeem their bank's money for the legal tender money at some point, if whether it's to pay taxes or whether it's to pay fines. So it actually incentivizes the other banks that are not legally privileged in the economy to hold the legally privileged money as new base money reserves alongside what previously was the base money. And this would just result in some kind of snowball effect, because now the legally privileged bank is still able to redeem whatever bank money it can get from the other banks at the interbank clearinghouse meetings, while the opposite no longer happens. So the legally privileged bank will simply slowly drain all the other banks in the banking sector out of their commodity based money, out of their gold, whilst all the other banks simply hold the initial banks, the legally privileged banks' money as the new base money reserves. Um, that's pretty much how the base money converts from the previous commodity money to this new kind of fiat money. Because obviously, this legally privileged bank is no longer held accountable by the law of adverse clearings. It no longer experiences adverse clearing. So its money supply becomes discretionary. They they no longer have to redeem their bank money for base money because people just have to have this bank's money for taxes and fines, and the other banks will now just oblige. And this slowly turns the banking sector from a competitive note issuance and deposit taking sector to simply a deposit taking sector, because the note issuance is no longer competitive, and it will slowly turn into a monopoly for the legally privileged bank that will henceforth will be referred to as the central bank, obviously. So uh, so again, because the other banks are slowly being drained out of their base money, it becomes more and more risky for these banks to issue money themselves. So at some point they will just quit and they will just loan out. Um, like instead of previously redeeming the legal tender money, they will simply now loan it out as bank money of themselves, because that's still how they can earn money. The interest rate payments of money they can loan out. Um, and yeah, at some point, the central bank will find it redundant to have this uh, base money redemption that has historically always been present in free banking to still exist, because people are just not redeeming that money anyway. They need that bank money to be able to pay in the economy, to be able to pay their taxes. And this is how a free banking system slowly evolves into a central banking system. I hope that was somewhat clear how that happens.
Yes.
Um,
Another question. When we look at banks being involved in a transition from a free banking system to a central banking system, or even banks within a central banking system that is already established, uh, are there concrete reasons why certain banks, besides, of course, the central bank, would prefer to have a central banking system over a free banking system?
yeah, that's a good question. I would say the kind of banks or the kind of bankers who would prefer a central banking system over a free banking system are the ones that probably would only want to engage in the deposit taking market as opposed to the note issuance market. So, by definition, I would say those are the kind of banks or bankers that would consider themselves like, if given a free banking system, they would be uncompetitive in a note issuance market. So these would be banks that know that if it was up to competition, they would probably be outcompeted by the other banks. They would have a low market share. So they probably would have a higher market share if it was a central banking system where you just have to take the deposits of the central bank money and you can loan out whatever money you receive from that bank. I mean, that's not the case under free banking. You have to really take a lot into consideration, estimate the money demand of your money, and just not issue too much money. In central banking, that's not the case. You just loan out what you have, because that means more income, like more revenue, and yeah, that's eventually what all you have to be concerned with under a central banking system. So I would simply say banks that are not competitive and would be outcompeted are the kind of banks that are in favor of a central banking system as opposed to a free banking system.
Okay. Yes, and I can imagine that, especially in a more highly regulated, and by that I mean a system where the government is more uh, in depth and directly involved in the banks, that type of system. There's also the potential of bailouts from the government, and
Yeah.
that could be something that banks that are afraid of being uncompetitive, even in the current system, would prefer.
Yes. Again, it's always to help out banks that are more risky. That also is one of the reasons why, in the long term, a banking sector becomes gradually unstable in a central banking system because only the banks that engage in the most excessive lending are the ones that are rewarded the most, either through having the federal deposit insurance, but also, of course, central banks, or no, no, not central banks, governments possibly bailing them out. And central banks, of course, will always try to regulate the liquidity of the banking sector. So they will always try to provide liquidity whenever they think that the banking sector in general is not liquid enough. So there's really many ways that reckless banks or banks that are not financially sound are just being rewarded, as opposed to banks that are more conservative or more, yeah, risk averse in their lending policies. And the worst part is because of these reasons, usually it is the risky, uh, reckless banks that are receiving higher revenues than the risk averse banks, even if they are unjustified in being so reckless. And then they can actually outcompete the more risk averse, calculative banks, so to speak. So they actually drive the more financially, yeah, risk averse, calculative banks out of the sector. Like they will get out competed by the reckless banks over time. Mm. So that's another problem in the long term of having central banking. But um, two primary ones I want to share here are spillover effects and cash demand fluctuations. So I'll first talk about the spillover effects. Um, of course, if you have an economy, it's like a domestic economy is nationwide, right? You have different geographic locations of different banks. So different banks will experience different, yeah, different geographic locations, and especially different banks with different customers will experience different liquidity needs, right? But if you only have one central authority over the issuance of bank money, and actually so I probably have to explain this first. So in free banking, it's very easy to see what is base money and what is bank money. Base money is simply the monetary base where you can redeem the bank money for, and the bank money is simply what every bank in the free banking system can issue. But in a central banking system, the base money is actually the cash money that a central bank issues to be printed, and um, so for individual banks in that system, the base money is both the cash money that customers hold and the cash money that is present in the reserves of these banks. And the bank money in the central banking system is simply what customers of a bank have deposited, so to speak, right? Electronically deposited, of course, in the bank. And again, the cash money that they hold as customers from that bank. So in a central banking system, cash money is both base money and bank money. And the fluctuations in that is something I'll talk about later, which is a problem in central banking. But just to explain that, um, base money, uh, that that cash money in a central banking system is both base and bank money, is something to be taken into account. So when a central bank issues So a central bank tries to regulate the amount of liquidity in the economy. So when it sees that on average there is too little liquidity, there's too little base money in the economy, it will simply issue more base money, and it will try to distribute that among the banks in that yeah in the banking sector. But the problem is that there is no way for a central bank to know how much liquidity is exactly needed in what geographic location or for what particular bank. There might be some banks that have very high liquidity needs, but there might also be banks that have very low liquidity needs at this point. Like they're still very liquid, as opposed to other banks that might be highly illiquid. And a central bank just doesn't. It's not possible for a central bank to know exactly how liquid or how illiquid each bank is in the economy, and therefore being able to send the exact amounts of base money that each bank in the economy needs. As a result, certain banks that are already very liquid might receive additional liquidity that they didn't need, and other banks that are highly illiquid might not receive the sufficient amount of base money that it needs to remain properly functional. So even if you assume that a central bank has a way to know exactly how much total liquidity has to be added to the economy to achieve a gross equilibrium, they cannot make it so that this equilibrium holds for each individual bank. And especially in the case of banks that were already liquid, receiving additional liquidity, that liquidity, that base money liquidity, for which the purpose was to simply make the bank more liquid in the case of base money redemptions, which is essentially just the cash money reserves that the bank has being withdrawn by customers that are converting their deposits, their electronic deposits, to the cash money. Instead of that, the additional liquidity is being used for these purposes. The bank will simply um, use that money for loans instead. Like basically, the base money injection originally meant to make illiquid banks more liquid again is simply used by liquid banks in the credit market. Like that money will be spilled over into the loan market, and will just be made. The banks will just use that as additional loans to make revenue out of, and that's what spillover effects mean. So it's base money intended to make illiquid banks liquid, spilled over into the loan market instead. Um, Historically, when these kind of economic bubbles or lending manias happen, that typically happens when interest rates are low, right? And that's kind of the thing. When there is an oversupply of money in the loan market, that makes it so that the interest rates are low. You would assume especially in a free banking system, that there would only be excessive loan making if the interest rates are high, because that's the income on loans that banks get, you know. But we typically see the opposite when it comes to lending manias in history. Those happen when interest rates are low, and it seems to me that these lending manias initially even just seem to happen because there is a spillover effect from base money intended for other purposes just being spilled over into the loan market, because banks that were already sufficiently liquid are receiving additional liquidity that they didn't need. So that's my explanation for spillover effects. The next topic here is cash demand fluctuations. So, um, as I said previously, cash money is both bank money and base money in the economy. So, in a free banking system, that's not the case. If a customer has a deposit, and let's say it's an electronic deposit of money at a bank, and it wants to convert this deposit money into cash money, it can simply go to the bank, and the banker will print on demand whatever bank money that customer initially had deposited. There's no problem in that. But in a central banking system, um, that bank money, the deposit money that has to be converted into cash money, simply comes directly from the base central bank money reserves that the bank in question has, right? Like every single bank only has a limited amount of cash money, that is the base money in the central banking system from the central bank. It cannot issue anything on top of that itself. So it is so the base money reserves of a bank will decrease or increase every single time just based on the cash demands of its customers, which is not the case in a free banking system where cash money can easily be converted into deposit money, and deposit money can easily be converted into cash money, while the actual base money, the gold, for example, does not change in amount. So the problem is that cash demand is very hard to estimate. It can increase during holiday seasons. Historically, in agricultural economies, it peaked, of course, in these harvest months. But it can also increase or decrease for various other reasons, like different changes to certain taxation can make that happen. Changes in interest rates, right? If there's less to be earned of deposits, if the deposit rates of banks decreases, then there's less incentive for customers to have deposit money instead of cash money. So cash demand will increase. So and also like black market operations. If those become more popular, then also cash demand will increase. So
Yeah.
it's hard. It's firstly hard for banks to estimate cash demand, and also it actually messes up their calculations of how much base money they would need for the long term, because every single increase in cash demand decreases their base money, which is not the case in free banking. So to the right here, um, I have again, this is the Selgin model, but the first few formula here are basically the adaptations to a central banking system. And the takeaway from this is essentially that since cash demand now also since the if the amount of base money in the system now also depends on the cash demand of customers, which is the small c here,
Yes.
um, money supply is no longer inversely proportional to money velocity. So money velocity can change a certain way, and money supply will never completely offset the change in money velocity. So this again causes instability in the banking sector, even if the central bank was 100% committed to adjusting money supply to money velocity. It would simply not happen because it's not inversely proportional anymore. And the same thing actually happens. These two formulae here are representative of what happens when you have a minimum reserve requirement, which is simply again a form of legislation that would not be present in a fully fledged free banking system. Pi here is the minimum reserve requirement, and again, without going into too much technical details, again under a minimum reserve requirement, the money supply is also no longer inversely proportional to money velocity. So same story sort of as in central banking, without a minimum reserve requirement, so to speak. And on the bottom here, we have a chart of the money supply of the US compared to the money supply of Canada. And do you see something particularly interesting about the trend of these two lines?
Well, I can see that the US's decreases a bit at first, and then it starts increasing more rapidly, whereas Canada's goes through several up and down cycles, and when it increases towards the end, it does not do so as much as the US's.
Yes. So Canada did not have a central bank until 1935. And even though the US also didn't have a central bank until 1913, um, the US had national banks between 1863 and 1913. So the national banks were not quite as central banks, but there was still a system that is pretty close to it already. whilst Canada had a pretty nice instance of free banking during the same period. And what we can see is a lot of seasonality in the money supply of Canada here, which is a good thing because that means that if there's changes in money demand or there's changes in other factors where you would like, money velocity, the money supply will simply adjust itself. So what you will see, what is essentially going on here is that there's always a peak during the harvest months when cash demand would peak, and free banks are can easily oblige to changes in money demand or money velocity, whereas in the US that is simply not the case. There is no seasonality at all in the US money supply,
Yes. So
and
so the Canadian supply in this period adapted better to demand.
yeah, exactly. Um, So we see empirically some resemblances from the theory that I've previously explained. Um, and then lastly, dollarization. This is something I will just quickly go over because it's not that relevant of a topic, but still, some people think that dollarization, like for example, I think it's Ecuador, Panama, those kind of countries. You know, their central bank is not credible whatsoever. Venezuela also. So instead, what people in those countries typically do is they use some near frozen amount of dollar supply, and they're dollarized economies, right? They use dollars instead of their own central bank issued currency. But what would have been smart for these people to do is they should have used these dollars as base money and then establish banks, and then those banks issue bank money that is redeemable in the dollar based money. And that would be like a free banking improvement on dollarization in and of itself. Because in dollarization, again, there is no adaptable money supply to money demand. Whereas if you create out of this dollarized economy a free banking system, as I've just explained, then again, bank money can be adaptable to money demands. Bank money can be adaptable to bank money demands. And also, there's also the benefit of seigniorage. And seigniorage basically means that if a bank issues a dollar of free banking money, the cost of producing that dollar is only going to be a few cents. Like you just print that paper note. So if you're able to loan that paper note out for $1 worth, then you basically made some revenue based on that dollar minus the few cents that it costed to produce that dollar. So that revenue, which is called seigniorage, is not present in dollarization because there's no money issuance. But in a free banking system, there still would be that additional income for free banks, so to speak. Let's see. Yeah, actually, that already brings me to the conclusion of going over the complete theory of free banking. My own conclusions, at least, is that there's a strong theoretical backing for this system once you really look into it. I think I've explained a model that is built on rational behavior that would follow from the typical setting of a free banking system. There are appropriate money supply adaptations in a free banking system, as we've both seen empirically, historically, and in the theory itself as well. And I hope I've also highlighted the central bank shortcomings sufficiently in the form of the spillover effect and the cash demand fluctuations. And um, that's my explanation. So maybe there's a few more questions I could address.
Well, I think your explanation was very thorough. Of course, looking into your thesis, it focuses a lot on the monetary situation of Scandinavia and the historical contrasts between the free banking and central banking systems in that region. Of course, you did go over to mention other things. such as in this presentation of the Canadian free banking experience, the American free banking experience, the Australian free banking experience, etc.
Yeah.
So there certainly does exist some empirical ground by which free banking and central banking systems can be compared, and therefore some reasonable ideas on how there could be improvements in the future.
Yeah. Exactly. Also, an important instance is the Scottish free banking. But yeah, I would say the big four are the US, Canada, Scotland, and Sweden. And of course, as you've mentioned, I did my research about the Swedish experience, and I found out that the economy was more stable than the other Scandinavian uh, countries, especially during the first, I think, 25 years of the Swedish free banking experience. After that, there were some economic crises in Sweden that were from international origin, so it was not inherent in the monetary system that there were crises, but yeah, they happen nonetheless from international sources. But if you especially compare the Swedish free banking experience to what would later be the central banking experience of Sweden, you see a vast, significant increase in instability and price level and output, and also in the growth of price level and output.
Yes.
Um, yeah,
So one final question I had, because I had some other questions, but you certainly addressed many of them as we went through. But at the end of it all, do you have any intention to spread further awareness of your thesis and the conclusions of your thesis in academic and policy circles? So essentially, now that you've done this research, now that you've written this thesis, where does it go from here?
yeah. I will certainly be motivated in the future to continue um, sharing this, well, first of all, my work and also my ideas, or especially the ideas that I'm trying to defend in academic or policy making circles. I think this is the most important topic in economics, period, because as I've hopefully highlighted, there are big problems inherent in forms of non-free banking, and as far as I'm aware, only a very select few amount of people or economists are even talking about that. Um, I hope I've highlighted these big problems that are inherent in central banking or government regulation, and have shown that because of this long-term existence of these systems, the banking system has gradually weakened and become more unstable. And at this point, I would say the banking system is so fragile. We've had the um, the Great Recession a decade ago, and even right now we've had skyrocketing inflation, which of course in part also was due to other factors. But it simply goes to show again just how fragile the financial system is. And what's being done right now is just some short-term band-aid solutions. But yeah, I don't know if and if the viewers takes a look at how valuable the dollar was 100 years ago compared to now, it's like maybe now it's maybe 1% of the value it had 100 years ago. Um, the the official policy of the ECB, for example, is 2%
That's the
inflation.
European Central Bank.
Yeah,
Yeah.
2% inflation year on year. But I think it's if you have 2% inflation for 36 years, year on year, I think that amounts to like half the value of the currency. Like in 36 years, you've lost half the value of your currency in that case. Um, like the current system is just not set up for long-term economic or at least monetary prosperity at all. And I think like the few times I hear mainstream economists refer to free banking, they quickly dismiss it. They say it's unstable, it's impossible, it's yeah, it would just immediately crash down. But I think if you really look into the theory, there is no such thing suggesting that. If you look at the historical examples of free banking, they've all been attributed to being more stable than their um, central banking counterparts, whether that's neighboring countries, right? I showed the money supply between Canada and the US. I've done the extensive research comparing Sweden to Denmark, Finland, and Norway. But especially just looking at a country before it had a central bank versus after it had a central bank, you can see a clear difference in monetary stability if you look at the statistics. At least that was definitely the case for Sweden. And I know that Larry Sackrest, which was the third economist that I referred to on the second slide, um, he's done the research comparing Scotland and the US, and he came to similar conclusions. Yeah, I just, again, I think this is the most important topic, the most important economic topic that almost nobody is talking about. And I think it is probably one of the most important contributions that I could possibly make to the economic literature and also as recommendation to economic policy to continue spreading awareness on the system that is free banking. Because I think, at least I hope, I have very well argued why it is simply superior if you want more economic stability and a more efficient monetary sector.
Yes, and I'm certain that you would be happy to hear different opinions on uh, how they imagine your system would work, uh, advantages and disadvantages, as fostering a larger conversation and perhaps even a larger body of literature on the topic would certainly only help to increase the thoughtfulness and the reasonability of the approach, and refine the theory to a point where it can be highly practicable.
Yeah. And the last thing I would highlight once again, this is not necessarily, not only the case for the topic we have at hand, but still, this is a good example for it. Whenever I try to discuss these kind of ideas with economists or people who are adherent to economists that are more mainstream inclined, they will quickly dismiss it. Even, I had to present my thesis to my university, um, and even though nobody is able to engage in argumentation when I just lay out the many reasons why central banking is inherently unstable and definitely more unstable than free banking, they don't, mainstream inclined economists will not even have an answer to these arguments. Yet they will still parrot the same ideas they have, even if they're not based in any credible theory nor in any empirical observation. And I think that's a very big problem.
Yes, so essentially, it seems that there has arisen a type of dogmatism
Yeah.
in understanding banking and money supply that leads to an intellectual blind spot to perhaps some of the major causes for instability in the economies of today's developed countries.
Yes. I'd argue that central banking is like a religion at this point. The ECB, the Federal Reserve, they're like religions to economists. It's crazy.
Yes. So anyway, do you have anything you'd like to shout out? Uh, of any kind?
So I thought a bit about that, and I think the best thing to shout out is simply the economists that I have extensively read and have learned me so much about banking, which are George Selgin, Lawrence White. Larry Sacris is already dead, unfortunately, but Selgin and White, they're still active. They're active on Twitter. They, again, the blog site that I referred to, um, alt-m.org is where they still, yeah, the site they use as a blog. They have academic articles, they have published books on this topic. Anyone who's interested in that should really read those books, because I think those are the only two economists that truly know how free banking is supposed to work. And I simply learned from them. And that's why I was able to provide so much information on the topic. So yeah, those economists are the ones, yeah, that I would plug for this topic for sure.
Yes, and I would like to encourage anybody out there that's interested in researching banking or monetary theory or just economics in general to at least have a look at these perspectives, since they offer an alternative to what is, you could say, the established economics of today, even though nowadays we see that the way things are going hasn't really been beneficial to us in general. And many people like to criticize central banking, but what's important when putting a criticism to such a large system that is an underpinning of the economy is to be able to offer a workable alternative. And I think the free banking theorists certainly offer that.
Yeah, I would agree, obviously.
Yes. So anyway, thank you for discussing this theory. I'm very happy to have hosted you. And I would also like to thank my viewers for watching this to the end. I know that it's been 3 hours, so so that's a bit long. But if you're interested, I'm sure you would have stuck around. As I understand that this topic is a topic that when you speak about it, people's eyes glaze over. They don't. Uh, they might not have the patience to look at it, but being something such as this is being important, uh, at least we would want people that have the mind to look into it to at least consider these ideas. So thank you all for watching, and I will be seeing you all next time. So have a good banking experience. Let's hope it'll be free soon.
Yes.
Yeah. Goodbye.